Chris, always a pleasure to have you on ET Now. Thank you for joining us. Thank you so very much for your time. Chris, what amazing market it's been. From a position of excruciating pain to a great comeback. What is your sense? Do you think we have all the ingredients in the melting pot so that markets can really forge higher?
Yes, it's a big contrast, but we have to put it in the context of the dramatic easing policies which have been introduced, particularly in America, and Europe, and the G7 world. And these extremely easy policies are definitely a part of the contributor to the equity rally we have seen. But the other issue is the rallies in the period since the pandemic hit has been very concentrated, clearly in stocks in the U.S., which were benefiting from the stay-at-home model, or the so-called new normal. So the rally has been very concentrated. But now, in the past week, we have seen what will happen if the pandemic ends or the health emergency ends. It's because we've seen a big rally in cyclical stocks on the Pfizer vaccine news, and that I view as a rehearsal of what would happen if the health crisis ends, i.e. a big rally, a big rotational trade out of the stocks that have benefited from the so-called new normal back to cyclical stocks.
Mr. Woods, in your last newsletter, you've mentioned that the vaccine is round the corner and that could lead to a cyclical recovery, point which you just alluded to. So my question is that, are we in a scenario where central bankers were forced to cut rates because of pandemic, and now that vaccine is on its way, central bankers are unlikely to roll back their policy action, which means that this pandemic in a sense has forced central bankers to bring interest rates down and to print money? And do you think that could remain more like a situation for next 2 or 3 years?
Well, then that's a very good question. And my view on the vaccine is, based on my talks with people who know much more about this than I do, that the technology allows researchers to roadmap a virus much better than they could in the past. So I believe that more than one vaccine candidate will be available. But I think the bottleneck in the vaccine is not coming up with the vaccine. The bottleneck apparently is producing it on a scalable basis. So I think conservatively we should assume this could be available by the middle of next year. My own personal opinion is that by the middle of next year, the pandemic itself would likely have abated and largely burnt itself out. So I think the pandemic will be naturally coming to a conclusion at the time the vaccines are available. So in my view, you pose exactly the right question. How will central banks behave if it suddenly becomes clear the crisis, medical emergency crisis, is over? At least not over, peaked. My view is it would be very negative for markets if the central banks then started to tighten. But actually, my base case is that the Fed will remain dovish even in circumstances where it becomes clear that the pandemic has peaked, ending, and where markets start to indicate cyclical recovery by such indicators as steepening yield curve or rising inflation expectations. The reason I'm expecting the Fed to remain dovish is because the Fed, in its September FOMC meeting, changed its policy to give itself room to formally overshoot its inflation target of 2%. The reason it's given itself room to overshoot 2% is because it's failed to reach 2% for most of the last 10 years. And therefore, I'm expecting the Fed to say we do not want to preemptively tighten to threaten to raise the risk that we don't meet the 2% inflation target. But the key issue for markets is precisely that. How does the Fed behave when we come out of this emergency, be it by a vaccine or by the virus naturally burning out, or most likely by a combination of two?
Mr. Woods, you've been making a point in your newsletter that you expect the FANG stocks or the 5-6 big tech stocks to halt. What implications do you think that could have on S&P? Because S&P is going higher because of the Apples and the Alphabets of the world. If they start reversing, that could lead to a lot of passive outflows.
Well, yeah, my base case, may be wrong, but my base case for the last 2 months is what you've said, that the FANG stocks have peaked as a percentage of market cap in the S&P. But because the market action was so concentrated in the S&P, I mean, in those particular stocks, other stocks within the S&P universe can rally. So in a world where we cyclically go back to normal, cyclical stocks can rally, even if the FANG stocks are not doing so well. So bank stocks can rally, for instance, auto stocks can rally, energy stocks can rally. These are the sort of areas that would rally in a cyclical. Airline stocks can rally. So we need to understand that the rally in the S&P this year has been incredibly narrowly focused. So on the threat of regulation, I think on a 5-year view, there's a major risk of regulation hitting big tech. But the devil's in the detail. The left wing of the Democrat Party will want to take measures which will, in my view, materially impact the market capitalization of the big tech stocks. But the Democratic moderate establishment, of whom Mr. Biden is a representative, they are very close to Silicon Valley and the tech leadership. In the Obama administration, and Joe Biden was obviously vice president then, the Obama administration was essentially co-opted by Silicon Valley and big tech. So we're just going to need to monitor the tensions between the Democratic establishment and the so-called left-wing progressive end. If there had been a blue wave, I think there would be a bigger risk of regulation of big tech. But this, obviously, the election result, while the Democrats have won the presidency, it's not the blue wave they were hoping for. But my base case is the FANG outperformance has peaked.
Mr. Woods, the Democrats mean more taxes. More taxes means less discretionary spend. That also means that there would be less money in hand of Indian consumers and corporates to do buybacks and to spend. That's bad news for economy. That may take care of fiscal deficit. That may have an impact on dollar. But ultimately, from an economy standpoint, that's bad news. So then why are markets excited? Why have markets rallied after they realized that the Democrats will occupy the White House?
I agree. That's a very good point. I think the markets are hoping that the fact that it's not a blue wave and that it looks like, although we're not sure yet, that the Republicans will control the Senate, will effectively stop more of these, will not enable the Democrats to pass or implement their more radical agendas. So the market will be hoping that the Republican Senate will stop big increases in corporate tax. The Republicans will be against $2 trillion Green New Deals. There'll be, so I think the market's hoping that the Republican control of the Senate will reduce the risk of more left-wing policies. It's also the case that Mr. Joe Biden himself is not a radical Democrat. He's extremely moderate. So in a funny kind of way, if the Republicans control the Senate, there's less pressure on him to implement extreme left-wing policies. But the progressive side of the Democrat Party is left-wing in a European socialist sense. Whereas the moderates are very different.
Mr. Woods, you know it more than anyone else that markets and economy can remain non-correlated, or they can remain disjointed for a long time. So in your experience, when you look at market cycles and the economy, How far do you think markets have run up? And how far do you think markets are ahead of the economy?
They are, but there's a big explanation for that, because we have to understand this is not a natural economic downturn. So historically, you have two major causes of economic downturns. One is overheating in an economy, leading to rising inflation and monetary tightening. That's a classic reason for a recession. And the second reason would be banking bust, or a problem in the banking system leading to rising non-performing loans, leading to a deflationary-driven downturn. These are the two classic reasons for economic downturns. This time around, we have a totally unprecedented trigger for an economic downturn. That is a pandemic, which has caused politicians in their wisdom to decide to lock down whole economies to address a pandemic where the average age of death in the pandemic is in most European countries 85. So this is not a normal downturn. This downturn has been caused by government fiat, and it can be reversed very easily. So that's why the market's so sensitive to any evidence, as we saw with the Pfizer news, that the pandemic could be peaking. And it's also why the single most important data is not what the economic data is happening, it's what's happening with the pandemic.
Now let's talk about your portfolio positioning, especially India portfolio positioning. Why have you decided to shift from Cipla to ICICI Bank?
I did that several months ago. That was simply to be more defensive. I did that several months ago. I would be going the other way now. No, I think now you want to add to domestic demand. I would say in the last 2 months, as it's become clear that, well, not clear, as it's become more hopeful that the cases have peaked, and as it's become clearer that the renewed lockdowns are unlikely, it makes sense to increase exposure to domestic demand areas.
Now, you always had a special preference towards insurance stocks, and if I look at a current model portfolio, well, you currently you're recommending your clients to have exposure to SBI Life. Anything specific what you like in insurance, and why do you like insurance?
That's just a long-term hold in my view. That's not a trade. No, because we know from other countries that insurance is a long-term area to. It's a long-term increase in penetration story.
You always raise concerns, Mr. Woods, every time when we've interacted in the past that India's capex cycle is not picking up. But now, are you getting convinced, looking at the evidence of freight cargo movement, GST collection, electricity consumption, is the private sector, is the capex cycle in India back on track?
Well, I'm hoping so, but frankly, I'm not going to believe it until I see concrete evidence, because we've been waiting so long. So to me, we're most likely to see a pickup in the housing market before we see a pickup in the capex cycle.
And if I may have a follow-up question, Mr. Woods, why do you say that?
In the housing market, we have the catalyst of lower prices and affordable interest rates.
Mr. Woods, somewhere are you disappointed about India's per capita income? Because frankly, India's per capita income is stuck between $2,000 to $2,500. We are not able to accelerate, at least on that front, whereas other countries have seen a remarkable uptick in their per capita. India, which has a great advantage in terms of the size and demographics, is somewhere getting stuck because of the inability to take the per capita income higher.
You mean, well, there's different demographics, right? No, I think clearly a huge issue for India is job generation. That's been a huge issue for several years. So you've got far too many people working in agriculture still compared to other emerging markets. So that's, I think, why the rural reform to try and introduce economies of scale to agriculture is a long-term positive. And clearly, the current Indian government is trying to promote manufacturing, which makes sense, and the labor reforms will go a long way to that. But I would say the single biggest challenge facing India is job generation.
Mr. Woods, globally banks are getting completely smashed, but India, it's a different kettle of fish. FIs, they are the large owners of banks like HDFC Bank or even for that matter Axis Bank. Do you think Indian banks currently have scope to outperform in this kind of an environment, even though when interest rates are low, and given that Indian banks have exhibited their ability to hold on to their NPS?
Yeah, well, I think it all depends on how, we're going to find out in the next few months with this loan restructuring, what was the impact on the consumer loan portfolios of the lockdown. So the banks have been rallying in the market, partly so the market's given the banks the benefit of the doubt. But the interesting point, as I said, is that the other positive was that they stopped the loan moratorium, because that could have been extended, and the banks were able to raise equity. So Indian private sector banks remain a good long-term story because they have a lot of potential to take market share from the state-owned banks. That's an ongoing story. Fintech represents a potential threat, but it may be the case that the best Indian banks just co-opt the fintech technology and use it in their own businesses. On the financial issue, in my view, the Chinese regulators were right to insist on greater regulation because Ant Financial is a big, it does a lot of consumer lending, and it had very little capital of its own capital involved in that consumer lending. So in my view, they didn't have enough skin in the game. So personally, I view that as sensible regulation by the Chinese authorities.
Mr. Wood, you also like gold, you also like Bitcoin, two ends of the spectrum.
Oh no, I think all investors should own both gold and Bitcoin, because not because of the policies being implemented by the G7 central banks. Because as I said earlier, I'm assuming, if I'm wrong, then this will be negative for Bitcoin and gold. But my base case is that the Fed maintains these dovish policies even after the pandemic is over. My base case is that you see a growing convergence of monetary and fiscal policy, by which I mean central banks, the Fed and the Euro, will be increasingly monetizing government spending in America. And I'm also expecting sooner or later the Fed to lock in bond yields, peg Treasury bond yields higher up the yield curve, i.e. impose price controls in the Treasury bond market. Such policies are bullish for gold and for Bitcoin.
So, Mr. Woods, what would you say is your best trade for next 1 year, 3 years, and beyond 3 years?
On a 1 year view, there'll be a lot of money made in cyclical stocks when the pandemic ends. So when I say cyclical stocks, I mean things like auto stocks, energy stocks, airline stocks, all the sectors that have been hit by the so-called new normal. In my view, actually, the best market to play that cyclical story is probably Japan. So you said 3 year view. On 5 year view, the best place things to own are what I said earlier, gold and Bitcoin.
Well, Mr. Woods, really appreciate it. I'm so glad you could join us, and thank you for your valuable time.